This goes into exactly what we are looking at today, which is taxes for your investments. So, um, thank you everybody for being here. I'll get to the title in a second. This is not the way we usually start. I usually give you a little preamble, but today we're jumping right into it. So, the example in this question or this quiz that I've got for you. Sorry to give you a quiz. I know you didn't expect that, maybe, but our example person, Bill, here has taxable income of blah, 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 and includes this and includes that. And if you're really inclined, go ahead, write it down. I'm going to give you the gist of it and what's going on here. But here's the key question that I want you to think about. So, Bill is a person, he's got this sort of income, it's listed on the side, and he needs to take out $1,000 for a road trip he wants to go on, just $1,000. And he wants to take it from his IRA, which is fine. Okay, that's going to be a taxable $1,000. How much in taxes will he owe on that extra $1,000? Now, my intuition when I would first look at this is to say, well, he probably falls in, it looks like the 22% federal tax bracket. So forget about state tax because we haven't thought about what state he's in, but probably about 22% of $1,000, right? How much will he owe? He pays 22 cents in federal income taxes. It should be 220. Wrong. And don't, if this looks weird, I'll explain exactly how you arrive at the right answer and why it's different. But I will confess that as I looked at this presentation for the first time, I also was a little confused. Wait, he owes $400? He's paying 40%? How does that work? Why is he paying so much in taxes when his federal tax bracket is 22%? I'm going to tell you exactly why in a couple slides. Not to be too salacious and bury the lead, but I will explain exactly how that works and why this is so important. So I hope that this original example here helped you understand. Maybe I'm sure you already did why taxes are so important of an issue. Where even a little $1,000 withdrawal, where that might feel like a drop in the bucket compared to our annual income, it can make a huge difference in terms of what you actually pay in taxes. Paying 40% is something we definitely want to avoid, and in this case, might have been avoidable. So, there's my little teaser. Welcome, everybody, to tax planning and how it changes through the 4 stages of retirement. And don't get too caught up on that headline where, oh, we're going to go through the 4 stages of retirement, are we, Anthony? I'm a person who doesn't believe that any one retirement is exactly analogous to anyone else's. There are a lot of similarities. There's going to be a lot of things we cover that have a ton of cross purpose, or in terms of what applies to one person will also apply to another person. That's our goal. But don't get me as one of those people that says, well, the first thing we're going to do is figure out which stage of retirement you're in. No, you're a person, you have individual goals and wishes, and we try to treat you like an individual here. So, welcome everybody. Forgive me for that little quiz preamble here. And if you don't know me, I think most of you do, but if you don't, my name is Anthony Gerbi. I'm an advisor at Stein Financial Group here. And because I know we have a mixture of people who work with us, who are clients of Stein Financial Group, welcome to all of you. Great to see you again. And we have some people on here who don't actively work with us. Maybe you've attended an event of ours in the past. Maybe you remember us from the Voya days for your deferred comp. I just want to make sure that everybody on this call is aware of our tax analysis capabilities or our service. If you are a current client with us, and I'll mention this again at some point, and we're actually sending out emails about this right now because tax time has just ended. If you currently work with us, we will do a tax analysis for you where we literally take your tax return, run it through our system, and look for all the different things like whether an extra $1,000 would make you pay 40% in taxes on that thousand. We do that as part of our services. So all you need to do is get us your tax return. We'll run it. We'll get back to you with the results. Sometimes the results are really impactful. Sometimes they're just good to know. And I'll explain kind of what the results we'll be looking for as we go through this. If you don't work with us currently, or if you've met with me for just a deferred comp assessment, but you don't have any investments with us right now, there is a small fee for that same service just to pay for the technology that we use to make it happen. It's $100 if you don't work with us. So again, if you do work with us, It's all part of it. No extra charge. If you don't work with us, we're still happy to do it. There's just a charge associated with it, and we can go through all that individually. But if you're interested in that, let us know and I can give you more info. So what I wanted to do is first tell you the most important thing I can tell you, which is I am not a CPA. I'm not an accountant. I don't do taxes other than my own and my family's basically. But I do have a good understanding, a very good understanding of how taxes play in, especially to your investments and all the things you need to be aware of there. However, I would never claim to know more than a CPA. So it's very possible one of you may have a question for me that I may say, ooh, that's a great question. I don't know the answer to that off the top of my head. Let me reach out to one of our CPA partners and get the answer so that I feel confident. And I may say that, and that's just my disclaimer. I'm not a CPA. However, this presentation is designed to mostly go into stuff investment related. That stuff I do have a great handle on. I deal with every day. So don't hesitate to ask questions. Just know that I'll be right up front with you. Ooh, that's a great question for a CPA. Let me get back to you on that one. So let's dive in. I do have a lot to cover. My goal, my certainty is that this will not take more than an hour. That's always the goal. As you know, I can be a little long-winded, so that's why I want to get going. So taxes in accumulation phase, which is most likely when you're still working, that's accumulation phase when you're still saving money, versus taxes in distribution phase, which is when you're retired and spending the money that you saved. Big differences there and a lot of things we need to think about. Here are some of the things that have changed with taxes somewhat recently. Or may change when you retire, right? So when you retire, you may not have dependents anymore. So child tax credits aren't going anywhere, but your children may have grown up and they're not dependents, so you can't claim them on your taxes. Well, there's $2,000 per person down, right? That's the tax credit right now. You may pay off your mortgage, which is great, but then you might not have the mortgage interest deduction anymore, right? And you might not have health insurance anymore. In fact, you'll probably be going on Medicare. You won't be able to save if you don't have income with an employer that sponsors a 401k to a 401k. You won't be able to contribute, which means that money every year was coming off your taxes. Now you're not using that as a tax. It's not even a write-off. It's just never hitting your taxes in the first place. So all those things change more or less when you retire. And a lot of you who are retired are like, yeah, they changed and I had to think about different things, but we managed. And that's the point of today. It's not hard to manage. You just have to be aware. And obviously, then new things would be Social Security, which, if you take one thing away and you didn't know this, and don't feel bad if you didn't, but if you take one thing away from this, maybe this will be the most impactful for people. Social Security is taxable. Every year, I run into a couple people who that surprises. And I'm no judgment on not knowing that. I live in this world. That's why I know it. But if you didn't know that, what that makes a big difference is when you start Social Security, if you didn't know it was taxable, you're not withholding any taxes from your check, and you're going to get a nasty surprise when you file your taxes at the end of the year and you find out you owe thousands of dollars because you never had anything withheld out of your Social Security check. So we're going to go into that more deeply, but it may be if there's one thing I can get out there, Social Security, taxable. Also, a lot of the people on this call are going to be in Minnesota because that's where we're based. Minnesota also taxes it on the state tax level. That may change in the future. We'll talk about that a little bit, but taxable federally and at the state level in Minnesota. So very important to understand. So what's the first thing you need to understand about retirement and taxes? And there's going to be a handful of these keys throughout, and I'm going to go into them in more depth. But these are basically, I'm doing the work for you. I mean, if you want to just take a picture of the screen or write this down, these are the things that you need to write down, in my opinion, to really understand about your tax situation, which is number one, you need to know what your after-tax retirement savings picture looks like, ideally before you retire. Okay. And what do I mean by that? Well, here's a good example. Let's say you have, this is going to use 401k as the example. A lot of the people on this call have 457s, or otherwise known as deferred comp. totally equivalent for these tax purposes that we're talking about. There are subtle differences between a 401k and a 457, but by and large, tax rules about the same. Okay. So just know that if it says 401k, just in your mind, kind of replace it with 457. So let's say you have 500 grand in a 457. Great. That's a fantastic number. You should be very proud of yourself. But depending on where your income is at, what is that actually worth to you if you were to take it out, take that money out? Now, hopefully we wouldn't have to take it out all at once, because then it would be taxable as income all in the year you take it out. That'd be a big tax bill. But look at the difference a 2% difference in tax rate would be. Now, you may be in a different tax bracket than the 35 or 37%, but the principle still holds. 2% difference in terms of what you pay for taxes could be a difference of $10,000 in terms of what that account is actually worth when you take the money out and pay taxes. And if you don't understand how that works, know that when you take money out of your 457 or IRA or 401k or 403b, as long as it's not a Roth version of those, we'll talk about Roths in a little bit here, you owe taxes on whatever the amount you take out is, and you owe income tax on that, not gains, just income tax. Now, when you call Voya or you call us to take your money out, you can have them or us withhold a certain amount. If you work with us, usually I or even Margie will recommend what we think you should withhold. That's another reason why the tax analysis is really important, because that even gives me a better idea. So especially if you work with us and you haven't done the tax analysis before, please do, because it even helps me do better for you by having that information. But basically, we withhold taxes off the top. So if you want to take out $10,000, we actually have to take out about $12,000 to pay the taxes on top of that, right? So know that the number you see in your account is not the same as what it will be in your pocket when you take it out. It's going to be worth less in your pocket because we have to factor that you haven't paid taxes on any of that yet. So that's the first key. Okay, so you might be asking, at least I'll still have Social Security to supplement my income. Maybe you even have a pension. Fantastic. Pension's also taxable. I think most people know that, but make sure you're withholding something from your pension, just like Social Security. Very, very important key there. So, okay, I'll at least have Social Security to supplement my income, pay Medicare. Did you know that Social Security and Medicare have their own, call them tax traps, and you need to plan for them too? So we're going to get into this. This is one of the most common things that people don't think about when they take money out of their accounts in retirement. And it's not necessarily bad, but let me go. So remember we did our little quiz, and I had the gotcha at the end. Oh, wrong. All of you probably guessed wrong. I guessed wrong when I read it the first time. Why were we wrong? All right. Remember our example. Bill, he paid 40% on $1,000 that he took out for a $1,000 difference in his income. I mean, literally $1,000 difference in income raised his tax bill by over $400. So why did that happen? Well, actually, the reason it happened is, and a lot of people don't know this, I mentioned Social Security is taxable. For people who are under a certain threshold, and I can give you that number here, Social Security is taxed at a 0% rate. So if you stay under that threshold, you actually don't pay any taxes on Social Security. Most people on this call are probably going to be above that threshold, but it's even going to be more applicable for Medicare. But if you go over that threshold, even by $1, now your whole Social Security check is, well, actually the next bracket is only 85% of your Social Security check. So it's not the whole check. But the next bracket up, which most of us fall into, 85% of that Social Security check now becomes taxable. So what happened in this example? Bill's extra $1,000 that he took out put him over the threshold that now made his Social Security taxable. Not 0% taxable, but 85% of the check is now subject to income tax. That was a big difference. And if he had taken out maybe more like $500, he could have stayed under that amount. So I bring all this up to clarify, or to give you all the example of, this is why it's really important for me to know where your taxes stand. I mean, if you want to keep track of this, God bless, more power to you. I'm not telling anybody not to do that. I find most people, their brain goes numb when they start looking at all these numbers, and you see what I've got up on the screen. You look at kind of a before and after, and what's my AGI, and most people just kind of glaze over. If that's your thing, fantastic. Then you're already ahead of the game. But if it's not your thing, when you call me and say, "Hey, Anthony, we're taking a road trip. I'm really excited about it. We just need $1,000 to kind of make all the cash work." And I'm going to say, "Oh my gosh, that's fantastic. I'm so happy you get to go. Where are you going? Let's talk about it." And $1,000, no problem. You're good for that. No, I'm not even going to worry about it. But if I didn't know that you were right on the edge in terms of income of paying tax on Social Security versus not having to pay at all, that could be an expensive mistake we're just making, and not a life-changing amount of expense. But this stuff adds up year over year over year. And if I had known, if Bill was my client, let's say, and I had known that where Bill's income was, I would have told him, "Ooh, do we have anywhere else we could grab that $1,000 from? Because here's what happens if we take it. It's not the end of the world, but just know you're in for a bigger tax bill than you might have expected." So that was the answer to the question. That $1,000 was enough to tip Bill over the line, which is just a red line that says if you're over this amount of income, you now pay taxes on Social Security where he wouldn't have had to before. That's why his taxes went up so much. So what this is showing, and this is just a further breakdown, he paid an effective tax rate of 40% because he tripped that wire. Looks like we had a question come in. Let me look at that. What amount do you have to stay under for Social Security not to be taxed? So great question. I do want to hit that. Let me not derail myself right here, and I'll get to that in just a second. So Medicare actually has a similar rule, and this is one that actually does play in a little bit more often. So here's an example. George and Martha, use this as an example or not. They have Medicare Parts B and D, so they're over 65. Their income was $322,000. Yes, and there's a key point that was just put in the chat, not to reframe it, but if one is married and filing separately, so if you're married and you file separately, you are in the 85% taxable category. So you're not going to be in the 0% Social Security category. Again, for any of you who are curious, I'm going to tell you the number when we get it here. But most of you probably aren't in the 0% Social Security category in terms of how much of it is taxable. But did you know that there's actually even a threshold above 85%? I would say 90+% of people fall into the 85% bracket, meaning only 85 cents out of every dollar for Social Security that you receive is taxable. There is a bracket above that, but we're talking hundreds and hundreds of thousands in income. So most people don't actually get into that higher bracket, but know that it is there, and it would be something, if you were close to it, that we'd want to take into account. So for Medicare, let's say they sell stock for $1,000 of gain, right? And don't worry about these numbers. Just say, well, they sold some stock, they sold at a gain. They're going to pay some taxes on that gain, right? Usually they would, but Medicare actually has brackets for where your premiums go up. And here the numbers are actually on the screen. So let me break this down for you. You can see single and joint. So my head on the screen is right above joint, but put yourself in whatever category. So if your income as a married filing jointly is north of $206,000, or just divide it in half if you're single, so north of $103,000, and you're on Medicare, your premium goes up $70 or $69.90 in that next bracket. All right. So you get a premium increase for, this is the key part, for the same insurance coverage. You don't get any better coverage for that premium increase. Okay. So Aaron's got the numbers there. Or Aaron just sent me to him. We'll go through that at the end here about the Social Security. I'll keep going and in the essence of time, and we'll get to that. So for Medicare, if your income as a joint couple is over $206,000, your premium gets bumped up $70 a month per person for an entire year. Now, here's the tricky part about this. In 2024, because these are the numbers for 2024, they are looking, and they being the federal government, Medicare, they are looking at your income from 2 years ago. You may have heard about this. This is a 2-year look back, is what it's called. And so they're looking at what your income was in 2022. Well, that actually makes it a little more complicated for us because that means what you're earning this year will matter in 2026. But they don't publish these brackets 2 years in advance. So we have to kind of guess where the break point is. But let me give you a real easy example of a real life situation. So somebody we work with who came in and their income, and they file single in this case, and their income was about $90,000 2 years ago. And it was going to be about the same this year, very stable income. And they said, hey, I'm interested in converting some of my IRA money into a Roth IRA, which is I'm in a pretty decent tax bracket. I think I could afford to do this a little bit. We'll talk about that whole mechanism in just a little bit here. But I said, okay, that I think that makes sense based off everything I know about you. But let me take a look at your taxes just to make sure that we're not crossing any lines here. And when I looked at it, it was like, oh, you have plenty of room in your income tax bracket to convert, let's say, $10,000 or $20,000 into Roth. But if we go up maybe 10 or 15,000 bucks in income this year, you're going to pay more for Medicare because you're going to go over that $103,000 threshold 2 years from now when they look back on it. And again, in 2 years, this number, it'll probably be more like 110,000 or something. We have to kind of guess at that. But I was like, you're close enough to make it, we got to be real careful about that. So to put this simply, if your income is high enough, you will pay more for the same Medicare that you were getting all along per person. So these cost increases, you can see the income bands here, are per person. There'll be a breakdown of it at the end. And not just for Part B, also for Part D, which is drug coverage. This also, at the same breakpoints, increases your cost. Now, yeah, $13 a month more in the second bracket. That's probably not going to bankrupt any of us, even though it adds up to certainly over $100 a year. But why pay that if we can avoid it? I mean, income is income, and all of us are very fortunate to be in any position to receive income that is to receive the income we're entitled to. And if that puts us into a higher tax bracket, in some cases, it's kind of just, well, so be it. I'm in a higher tax bracket. It's nice to have the income. It's a good problem to have, right? So I'm not saying it's a bad thing necessarily, but if it was avoidable, why not save that money is kind of the point. And that's why I need to know where you are at with your taxes, specifically so that I can say, oh, hey, you're totally fine. You're good for this money that you want to take out. But if we take out a little from here and a little from there, maybe we can avoid these extra charges and still get you the same amount of money in your pocket. So it helps me kind of figure out where things should be coming from. So in the example that we just did, where their income was, they were filing joint and they were in about the 380,000 range, I think, in income, they're selling $1,000 worth of gain in stock added up to an extra 3,000 bucks that they had to pay in taxes that year. Now they're in a pretty high income tax bracket. They're making 380. They can afford probably an extra 3,000 a year. So it's not, again, a make or break for everybody. But why pay it if you don't have to? Again, you don't get better coverage for this premium increase. It's basically just a tax that goes up because you are earning more money. That's how it works. And the 2-year look back thing really makes it confusing for people. One thing I will mention on this, and then we'll move on. If you have a weird income year, and I've had this with multiple people where we just had a ton of income this year. I worked, but I'm now going to retire and I'm going to be in a lower income here going forward. But man, we're really going to get smacked on our Medicare because I was doing well. I was earning a lot of money when I was still working 2 years ago. Is there any way for them to just kind of hey, this was a one-off kind of thing. It's going to be different going forward. Can we get it forgiven or lowered or whatever? I used to tell people that yes, there's technically a process to go through where you can say, look, this was a weird year 2 years ago. Can you give us a break? Can you keep us at the lower premium amount? There technically is, but I used to tell people I wouldn't even bother because I've never heard of anyone getting it forgiven. It seems like it's incredibly hard to do. In fact, it seems like most of the time they really only do it when you file your taxes wrong and you add an extra zero maybe, and they're like, oh, you clearly just made a typo. Yep, we'll fix that. Blah blah blah. I used to say that until I had somebody I work with who did that and was successful and did get their premium reduced, even though they had a higher income year. And it was exactly for the reasons I kind of laid out. It was the last year they were working. They happened to earn a good chunk of money. It's going to be different going forward. They went through all the procedures with Medicare to say, look, my income was higher 2 years ago. It's not going to be like that going forward. Here's why. They have a whole procedure for it. And they were able to get their monthly charges reduced. So I won't say it's impossible. I'll say it's rare from what I've seen that actually happens. But there is a process where, again, if you don't want to be punished for this weird one-off year, and inheritance is another thing that kind of pops up that can really affect this. That would be one they would be even more inclined to forgive. It's like, look, my parents passed away. I received a bunch of money. It all added in. It was just a really weird year, let's say. Can I not go into the next income bracket because of this? They'll occasionally, at least, give you, yeah, you can stay. You don't have to pay the extra premium. You have to apply for it. It doesn't just happen out of nowhere, but know that that's an option. Um, all right, so this is just more example of what that item was. So here's something about Medicare, and I find everybody gets really nervous about Medicare penalties, which are effectively a tax. That's why we're talking about them, for not signing up in time. And I'm here to kind of explain how this works. So, if you are 65 or turning 65 and you're not working and you don't have coverage through work, obviously, if you're not working, you probably don't have coverage through work, you are required to sign up for Medicare, Part A, Part B, the whole shebang. And if you don't do it, there are penalties. So you need to do it if you fall into that first circumstance. But if you are still working and you have coverage through your employer, like the example in this case, you do not have to sign up for Medicare. Even Part A, you don't have to sign up for, and there won't be a penalty. All right. Now, as soon as you retire, if you're over 65, then you have to sign up immediately for Medicare. So don't drag your feet on that, because then a penalty would apply. But let me say that again. If you're 65 or older, still working, and your insurance coverage is through that work, you do not have to sign up for Medicare, and there is no penalty in that specific case, which does affect a good number of people. A lot of people are working past age 65 these days. So you may, even in that case, want to sign up for Part A of Medicare. And Part A of Medicare is, quote unquote, the free part of Medicare, which, if you've heard me talk about this before, I will tell you the free is the misnomer there. It is not free Medicare Part A. You just don't have to pay an extra premium for it, because that's the part that you paid for out of your payroll taxes all the years you did work. So yes, it doesn't have a cost year over year to you going forward. That's because you've already paid for it. So in that sense, it is not free. But excuse me, a lot of people say, Anthony, I don't pay anything extra for Part A. Why wouldn't I sign up for it? There's one main reason why you wouldn't sign up for it. And you may still want to sign up for it. But if this is you, you may not want to. If you work for a large employer, which, you have dozens of people working there, I believe the cutoff is actually 10 employees. I may have to double check that. But if you work for an employer that has more than 10 employees and you have a health savings account, okay, an HSA. Now, not an HCSP, healthcare savings plan, not a flex savings plan. There's a bunch of those different types of plans. Only an HSA is what matters for this point. If you're working for a large organization and you have an HSA, if you sign up for Medicare Part A, you can no longer contribute to that HSA. So that would be the main reason why once you hit 65 and you're still working, you would not sign up even for Medicare Part A, okay? But if you don't fall under that specific circumstance, then you're probably going to want to sign up for Part A, even if you're still working. And if you're not working, you definitely need to sign up for all of Medicare, because then there's a penalty. So in the example I've got on the screen, once this person, the fake person in this example, Jim and Ann is still working. So they get coverage, Jim and Ann, through Ann's employer who offers retiree insurance. When should they enroll in Part B? You can't get Medicare coverage instantly, so you need to be proactive. If you miss your enrollment window, you pay 10% of the base premium for life as a penalty. So what you need to do is enroll and be in Part B as soon as you retire, if you haven't when you turn 65. So again, you do not have to when you turn 65, as long as you're still working and as long as that work offers a retirement plan. But as soon as you retire, you need to sign up for Medicare. And you want to do that probably proactively. You want to do that, start the process a couple months before you retire, so there's no gap in coverage there. But that's a real thing that a lot of people don't understand well, is you don't have to sign up for Medicare if you're still working. You may still want to, at least Part A, but you don't have to until you retire. Then you have to. That's the gist of it. So let's talk about some other items here. Key number 3, you must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. So this is really the ideal scenario where you've got maybe at least 2 of these different categories: taxable, tax-deferred, and tax-free, or even all 3 that you've got to use from. And here's why. So when you call me up, let's say you work with us, and you say, Anthony, I need $1,000 because we're going on a road trip or whatever. It's steal from the earlier example. What I do then is I say, okay, where is the best possible place tax-wise to take that money from? And if you have multiple types of accounts that are taxed differently, that just gives me more options to make it work better for you. So don't feel bad if you only have one type of account. If you do, then it's probably pretty straightforward, and that's not a terrible thing. But this is what somebody like me really puts a high premium on, because, for example, I may not want to take that money out of your 457 or IRA pre-tax, because then you pay income tax on it. Rather, I might want to take it out of a taxable account where you only pay taxes on the gains, because there's a different tax rule there and it fits into a different column, and it might end up saving you money to take out the same amount of money, right? And I'm being a little general because, of course, this is very different for very different people. But that is a huge key. And again, not to, I guess, toot our own horn too much, but that's what these tax analyses are for. So I can see where your taxes are at. So I'll be able to tell you then, hey, by taking out this $1,000 in tax or from your IRA, I expect you're going to owe $200 in taxes on top of that. Or by taking it out of this other account, $1,000, I expect you're only going to owe $150 in taxes. Well, if we can save the taxes and it doesn't hurt us any other way, why wouldn't we do that? So it saves you money in the long run to have this tax analysis done. So I know when you take your money out, how to save you taxes the best way. And I'm not, that's not just something, we throw in because, I want to be nice and help you save taxes. If you have your money with us, I'm required to do things in a way that works out best for you. And I alluded to this earlier. Roth conversions. Let me explain what a Roth conversion is, okay? A Roth conversion is taking money from a traditional or pre-tax account, 457, for example, and converting it to Roth money, a Roth IRA in this case. And what does that mean? A Roth IRA is the other side of a coin from a traditional IRA or a traditional 457 or 401k, which means a traditional IRA, the money that goes in, you don't pay taxes on it until you take it out. A Roth IRA, you pay taxes when the money goes in, but you never pay tax on it again, and you never pay tax on the growth on that money whenever you take it out either. So, what you do when you decide between do I want money to go into a regular IRA or again retirement account through work 457 401k or do I want it to go through a Roth account is when do I want to pay the taxes? That's the decision you're making. A Roth says I want to pay the taxes right now. A traditional says I want to pay the taxes later. All right, so that's what we're deciding. So why would a Roth first off, what is a conversion? It's money from a pre-tax account into a Roth account. And you can do this up to any amount. And this is one of the reasons why I usually tell people, obviously depends on your circumstances, but if you're still working, probably you put it into a pre-tax account, a regular 457, and because you can always convert it to a Roth later. You can't go back, by the way, you can't go the reverse. You can't convert from a Roth to pre-tax because you've already paid the taxes in a Roth. The government's not going to write you a check for the taxes you already paid. And it probably wouldn't make sense to do that anyway. But so you can always convert later from pre-tax to Roth, not the other way around. So I believe our next slide is going to get to this. In general, what I try to look at to see whether this is appropriate or not is what we call filling up the bucket. And what these buckets are meant to represent, let me get out of the way, are the tax brackets that all of us pay for federal income tax. So the first, what is it, about $10,000 or even more than that? I'd have to look at the brackets again. Your first tax bracket is 10%, then it goes to 12%, then it goes to 22%, then it goes to 24%. And the idea here is, let's say that your income, you have a $20,000 gap before you fill up the 22% income tax bracket. So in other words, you could earn another 22,000 and you would still only pay 22% on that on that 20,000 before the next dollar would go into the 24% bracket. Okay, you with me? So you've got a gap there. What if we convert the money from your pre-tax account in that right amount to fill up that bucket to get us right to the edge of the 24% tax bracket without going over? And then you pay the same tax rate you're paying on every new dollar in that bucket already, but now it's converted to Roth, where you'll never pay taxes on it again, and it will grow tax-free. And you never have to take money out. Roth IRAs are not subject to required minimum distributions, and your heirs inherit that money tax-free as well, versus a regular IRA where they inherit it, and yeah, they'll have to pay the taxes on it just like you would have. So if we do that year after year after year and gradually fill this up, instead of doing it all in one big chunk where maybe we do kick ourselves into the 24 or 32% tax bracket, we do it year over year, we can minimize the taxes by spreading them out, not necessarily pay any more in taxes, and now you've got this tax-free bucket of money that you can access at any point. You can access it. There's no restrictions on when you can access it. There are a couple things with Roths about you can only get the gains out after 5 years, but for the start of it, the majority of the money in there is going to be the money you put in. You can always get your principal out. So A, we should be having this conversation at some point. But B, it's something for those of you who don't work with us directly, I would encourage you to think about it. If you want to talk to me about it, great. Sign up for a deferred comp assessment. If you want to just think about it on your own, great. But just know that this option is out there. Okay, I did see a question come through. Let me get that pulled up here. Okay, so question is, have our 457 through us. Do you offer all this help with other investments like para and Social Security? If so, is the cost baked into what we already have via Voya? Okay, so I've got a couple things to unpack there. First off, great question. Our group, Stein Financial Group, Jeff Stein's group, myself, we are no longer with Voya as what's called our broker dealer. A lot of you on the call may already know this if you already directly work with us. So what I mean by that is we don't manage the Voya deferred comp plans anymore directly. right? So that there's a charge that Voya charges everybody. It was like that. We were at Voya up until a couple years ago. I won't go into all the details there. Voya sold part of its business. That's why we're no longer there. But to answer your question, we do not work directly with your 457 accounts anymore. So my first point to bring up would be absolutely, we do everything you just brought up in this question, Jen, but we don't do it right now. You have to come to us individually for us to be able to do it now because we're no longer with Voya. We're now with a company, some of you know this already, called Cetera, which is like et cetera, but pronounced Cetera, Cetera. And again, that was because of a Voya sale. But don't feel bad for not knowing that. Voya did not do a real, well, it was kind of in their incentive not to report that we were not on there anymore, to be totally frank, but they did not scream it from the mountaintops that, hey, just so you know, all these people are leaving over here. Then they're now in a different place. So my point is, Jen, we should have a conversation. It would be, what we should do is sign up for a deferred comp assessment. Aaron, can you put that link in the chat at some point here? And we should talk about it because I can then explain what we can do and what we can't do, given that we're not at Voya anymore. So we should at least just have a conversation, Jen. So that's a great question for other people. You're definitely not alone in thinking that, hey, my accounts are through you guys, right? And it's like, well, when we were at Voya, yeah, they were, but not anymore. So I hate to pull that rug out from under you, but it is an important question that you've asked. And we can absolutely still help with your investments, para, and Social Security. We can do all that. You just have to engage us individually. And we can go over details one-on-one about that. I won't take up more time here. But thank you for that question. Very important. Okay. So what are some other approaches, just very briefly, that we can get to? Withdrawing tax-free money from life insurance to keep your income low. I generally only recommend that in a real clear case of if our income goes up anymore and we need this money, absolutely need it, we're going to be having bad consequences tax-wise. In general, I like to keep life insurance funded unless we knew that life insurance was going to be used for this, unless it was baked in from the very start. But I don't like necessarily cutting off life insurance if we have other options that, yeah, maybe we pay a little bit more in taxes, but it's not a life-changing difference. So that's really a case-by-case basis. Sell highly appreciated stock for low or no capital gains. Here's something that we do again, and this is really something we specialize in, is if you have an account, not an IRA or a 457, but if you have what we call a taxable account, where you get a 1099 on it every year, tax form, if you have gains in that account, you pay tax on the gains. But if you have at any point losses in that account, the market's down a little bit, like it has been the past, couple weeks here, we can sell some of your assets at a loss and cancel out some of the gains you have. In other words, we can wash them away and make it so you don't have any more gains to pay taxes on because we cancel them out with losses. That's something I'm looking at to do all the time with people. Where can we take advantage of this? I would rather have no losses, period, but the market goes up and the market goes down. And this is a way we can get a tax benefit even when the market goes down. So again, if you don't have a taxable account, quote unquote, if you only have a deferred comp, then this rule doesn't really apply. But if you have more than that, this rule does apply and we should be taking advantage of it. And timing your distributions. When should you take money out to minimize the taxes? That's a constant question we should be asking. Okay, now we're going to talk about something a lot of you maybe know about, but something that is very underreported, although it's getting better. I've seen a lot more articles about it lately, called qualified charitable distributions, or QCDs. All right. Now, there's a couple benefits to this, and there's a couple nuances here. First off, what is it? It's giving money from an IRA only in this case. And if you say, well, so I can't do it from my 457, you'd have to move your 457 into an IRA, which is totally allowable. It's a lateral move. It doesn't change anything tax-wise, but you can only do this giving from an IRA, not from any other work retirement account. So that's a very key point here. But here's what it is. And I'll give you real world examples because we do this every year with tons of people because it's really a beneficial thing. If you are 70 and a half or older, so if you're under that, you don't even qualify for this, don't worry about it for right now. But once you get there, you are eligible to give money to charity directly out of an IRA. Meaning, if you work with us, you're going to tell us where you want the money. We're going to get you a form that says, here's where it goes, here's the amount. You sign at the bottom. Money goes directly from your account to that charity. And it doesn't have to be, a national charity. It can be the food shelf down the street, as long as they have a tax ID number verifying that they're a nonprofit, which almost every place does. That you would even want to give to, right? You can't give it to the grandkids though. They're not, that might be charity, but it's not officially a charity. That's the key. So it's giving money directly out of your IRA to a charity. Why would you do this? All right, there's two reasons. First is, most of us these days, statistically speaking, are not itemizing our deductions on our taxes anymore. If you are, great, more power to you. You're still getting a bang for your buck for any charitable giving you do. But for those of us who aren't itemizing, in other words, the standard deduction on our taxes is bigger than the benefit we would get if we added up all our itemizations, you're not actually getting any tax benefit for your charitable giving then, if you're just writing a check to whatever place you want to give, or multiple checks, whatever. But if you give it out of your IRA, it is completely tax-free, and it's not a write-off. It's literally income that never touches your tax return. All right. So it's like it was never there. In other words, it's money you saved pre-tax, and then it left without being taxed. So that money was paid to you, grew, and was never taxed on the way out. Right. And it's, again, you don't have to itemize your deductions to take advantage of this. It never shows up on your taxes in the first place. So this has become really popular, given that the standard deduction for taxes is so high right now, or higher than it used to be at least. But two, there's a second benefit. Once you hit the age at which you have to take out an RMD, which, just so you know, right now is 73. It's changed a couple times in the last couple of years. Right now it's 73. In 2033, it's going up to 75. So in other words, if you turn 73 between now and 2033, the age is 73 for you. If you're still younger than that, if you're not going to turn 73 before 2033, then it's going to be 75 for you, but it's going to be in your 70s. All right. Let's leave it there. So once you have to start taking money out of your account, which means a percentage of your account comes out every year, is forced to by the IRS. Why do they make you do it? So you have to pay the taxes on it. This is all pre-tax money that you've saved. And this applies to IRAs. It applies to 457s, 401ks, anything where you saved money tax deferred. All right. This is the point at which you've deferred it to, when you're in your 70s. That's when the government starts making you take just a portion of it out, not the whole thing. People think, well, don't I have to empty out my account? You don't have to empty it. It's just a percentage. It starts out at about 4% of your account. So it's not even necessarily a huge number. But if you give any of that money to charity, it counts towards the amount you have to take out without you having to pay taxes on it, which means it is the only answer to one of the most common questions I get about RMDs, required minimum distributions, which is, Anthony, is there any way to take this money out that they're forcing me to take out without paying the taxes on it? There is. There's one way. You don't get to keep the money, so that might be the deal breaker. But if you're giving anything to charity, and you don't have to give a whole amount, you see right here, you can give up to 100,000. Very few people are that generous. It could be $100, literally. $100, totally fine. That's $100. Not only that will never have been taxed, but also counts towards the amount that you'll have to take out one day, in which case you'll be satisfying an amount that would have been taxed otherwise. So it's kind of a win-win there, right? So that's why it's become really popular, because of the tax code. If you're curious about how this works or want to hear more about it, let me know. We can go into it one-on-one and kind of see how it applies to you. But just to give you a story, and I like to highlight this, this is, an extreme example, extreme, I guess, generosity. But we have someone we work with who is RMD age, meaning they have to take out a chunk of their account every year. And they're in a very fortunate position where they don't necessarily need that money. I mean, if it was up to them, they'd probably just leave it in the account to grow. But what they've decided to do is get the whole family together, so kids and grandkids every year, and say, hey, where do you want to donate grandma and grandpa's RMD this year? And they send us a spreadsheet with about 40 different places on it. Probably a little less than 40. It seems like 40, but we're very happy to do it. And some of them are, your classic organizations like Red Cross. I don't know if Red Cross is literally on this one, but big multinational charitable organizations, stuff we'd all know. And then other stuff is, I always like to look through it every year because then you'll see the Sea Turtle Conservancy Fund or the Giraffe Conservancy Fund. And it's like, oh, that's what the grandkids picked this year. So it's a fun thing for the whole family. I'm not saying you have to do that. I'm not saying you have to give anything. But if you're this age, over 70, and especially if you're having to take RMDs, this is a way to save on taxes, still give to the places you want to give to, and maybe you even turn it into a family thing. So I just wanted to throw that out there because it's such a cool idea. I like to, share cool ideas when I have them. So, what's the cost of a non-QCD? I've kind of gone through all this, but let's just say you took out money from your IRA and then wrote a check to the charity. Well, you'd pay income tax on that money you took out. Let's say you wanted to give $5,000, you'd pay $1,200 if your tax bracket was 24%. So you'd actually have to take out $6,200 to donate $5,000. But if you do it through a qualified charitable distribution, you send the $5,000 directly, pay $0 in tax, and now you've saved money in taxes and given the same amount. So this is just the mathematics behind what I just went through. So let's talk at the very end here about what happens to money that you pass on to the next generation. Organize, obviously, we want to be organized for the next generation. Any of you who've had to clean up for a loved one that wasn't organized know how important this is. So here's a few check marks. I'm going to let you take a look at them. We can look, pre-retirement, know your after-tax savings before you retire, early retirement, get your Medicare and your Social Security lined up, get a strategy in place there, very important. Look at doing Roth conversions, perhaps. Middle retirement, now your RMD age, maybe you're able to give some of that to charity every year and reduce your tax bill. Great. And late retirement, organize your assets for tax efficiency in estate planning. All right. So what that means is getting things titled correctly, getting the beneficiaries on your account who you want them to be, organizing your will in the way that you want it to be. If you haven't looked at your will in, let's say, 10 years, I mean, really even almost 5 years, but 10 years especially, or if you move to a different state in retirement, that's also a good time to get your will looked at because state laws vary. Get that at least looked at. Okay. I'm not saying it has to change, but I would recommend an attorney. If you're looking for names in the Minneapolis area, we've got a bunch. In fact, I just updated our wills for my wife and I. So I have firsthand experience and I went to the person we recommend the most. So I, put my money where my mouth is there. But it's just important to do, even if it's not a major change. But we need to make sure your beneficiaries are titled right. We need to make sure everything's kind of organized. By the way, we have a document. You can find it on our website or just email us and let me know, called the What If I Die Workbook, which is literally like a 40 or 50 page book. We keep it in a PDF mostly because it's a lot of times easier to have that on a computer screen versus a giant binder in your hands. But you go through and it just asks you questions. What types of assets do you have? Where are they located? What's important to you? What types of insurance policies do you have? Anything you would want the person who's going to clean up your estate to know goes in that book. And it doesn't come back to us. It's yours to keep, but you put it in a folder somewhere secure, so that, and let somebody know where it is, at least, even if they don't look at it. And then that gets everything into one place. It's basically, break in case of emergency. Basically, look at this book, everybody. This will tell you exactly what I have, how to get at it, and what it all means. So if you're interested in that, let us know. Send me an email. Our contact information will be on the screen in just a minute here, and we'll make sure we get it to you if you don't have it already. Again, you can also find it on our website. So go there as well if you just want to pull it yourself. But let us know. Happy to email it to you. We can even mail it to you if you want a physical copy. Okay. So because your tax exposure will change throughout retirement, so you need a tax strategy that anticipates how and when you tap assets to cover your personal expenses. understand the range of taxes, and manages your actions so that we do things in the most tax efficient way possible. That's usually where you save the money there. So I'll say it one last time. Everybody who works with us directly, and again, you may be finding out that your deferred comp isn't with us directly based on that question we had. Sorry about that. That was a Voya decision, not an us decision, but we can still work with you. We just have to do it individually now. If you work with us already, this is part of our service to you, meaning we do a taxes and retirement planning meeting. You need to get us your taxes so that we can do it. So literally just an scanned copy is great. Physical copy is fine too. We can scan it. But let us know if you'd like to take advantage of that. We'd like you all to take advantage of it. So genuinely, even if you're like, Anthony, I don't think this is going to turn up anything, let's just do it anyway. Worst case scenario, you're right. And yeah, it's all what we thought it was. Great. But best case scenario, maybe I could find a way to save us a little bit in taxes, even if it's just a couple $100 a year adds up. So everybody who works with us gets this. If you don't work with us directly, we can still do just this service without you having to work with us totally. And there's just a fee for it. But you get a meeting, we go over the results together, all that stuff. So I think it's a really good value. I do have time for questions. Here's all of our contact information, though. I know we're right at time here, so thank you, everybody, for being here. I totally understand if you need to hop off. I'm going to get that number for the Social Security breakpoint here pulled up. And any other questions that come through, I'm happy to go through as well here. So in Minnesota, I'm looking up those Social Security tax brackets right here. In Minnesota, oops, let me get back to my screen here. If you make less than $25,000, your Social Security is taxed in Minnesota specifically. I'll get to federal in a second at 0.4%, less than $25,000 in income. Most people are going to be above that. If you're between 25 and 50,000, then 16% of your benefit is taxable. So I'm not saying you're paying 16%. I'm saying genuinely 16 cents out of every dollar is taxable. And then 50 to 75,000, 50%, just over 50% is taxable. 75,000 to 100,000, 72% is taxable. And then north of 100,000, it actually gets closer to the federal brackets. But now I'm going to pull up the federal numbers here. All right. So for Social Security, if you make less, and this is federal now, if you make less than 32,000, you pay 0% taxes on your federal Social Security. If you make between 32 and 44,000, you pay taxes on 50% of your Social Security check. And if you make 44,000 of above, you pay 85% on your Social Security check, which again is what most people, and those are joint numbers. All right. So it's actually less if you're single. Most people on this call are going to be above that. You're going to be in the 85% bracket. But in the case of our example from earlier, that person was at 44,000 and they bumped up to 45. And that actually made a big difference in their taxes. So thank you for bearing with me on that. I thought that was in the presentation, but I guess it wasn't. So we'll have to fix that for next time. All right. I did get another question here. Retiring, we've got a spouse retiring, 14-year-old child is going to take Social Security, and we're going to use the family benefit and receive a check for the child to help pay for high school. How will that affect our taxes? And will she have to pay taxes on her checks? So I believe it goes through the same income tax screen, basically, that everybody else's does, which means, let me double check this real quick, because that is a great question. So the question, to repeat to everybody, is this couple, they've got one of the spouses is about to turn on Social Security, but they still have a child age 14. If you didn't know, if that situation applies to you, you can get Social Security benefits for the child until they turn 18. A lot of people don't know that. You don't have to, it doesn't have to qualify for, disability or anything. It has nothing to do with that. It's just part of the Social Security program. But your parent, in this case, for the child to get the benefit, has to go on Social Security for this to kick in. So once they age out of 18, the money won't be there, but it wouldn't qualify for it either at that point. But let me double check this real quick, because that is a great question. So the question is then, when the child receives this benefit, will it be taxable? Yes. So it looks like they are quote unquote taxable, but you use that same income bracket that I just talked about, meaning if it's under 32,000, they're not paying income tax on it because they're in the 0% bracket. So the real answer is, will you have to pay income taxes on it? Most likely not, unless this person, your child's got a really high paying, after school job or something like that. And if so, then yeah, they might have to pay taxes, but more power to them. But as long as they're under that $32,000, that's the married couple. So actually, it's more like 16. Let me rephrase that, because this person, I'm assuming, your child is not married, I'm assuming. So then cut that in half. But as long as they're not earning more than that, than 16, I'll double check that number here. Then they would not have to pay it. So in other words, it goes through the same filter that it does for adults. The base amount. So if you're single, don't just cut it in half. It's 25,000. So 32,000 if you're married, 25,000 is the income limit after which it becomes taxable. So in other words, it's less than 25,000. Anybody else who wants to set up a time to talk about your specific situation, we absolutely do that. We're more than happy to do it, and just get in touch with us. So with that, thank you, everybody, and we'll see you next month here. Take care.